Hello, can everyone hear me? Yes, thank you so much. You're welcome to the transfer pricing webinar series. This is the second part. We held the first part a few weeks ago and more parts are coming in. Today, we are focusing on transfer pricing audits or reviews in East Africa. We are joined by eminent tax administrators and experts across the region, particularly from Uganda, Kenya, Tanzania, Rwanda, and Ethiopia. It is often said that taxes are very certain, but that may not always be the case. And in cases for transfer pricing, for instance, while one may ensure that the Revenue Authority will come in with certain charges, it is not always clear that what method you've chosen or what compliance measure you've taken is the correct path. And that is where audits and reviews come in. So while that certainty is not always there, it is often important to ensure that your analysis is okay, your compliance measures taken are right, the delineation is based on an actual function analysis that takes into consideration a lot of items. And that's what makes this particular webinar very important, to introduce you to some of the key aspects that the various revenue authorities will be considering. The program for today shall follow some opening remarks from the tax director in Uganda, and then we'll jump into the presentations from the various revenue authorities, and we'll end with closing remarks from the tax director in Kenya on this matter. In relation to Q&As, if you have a question for any person, kindly put it in the Q&A section, and the participants are also free to include their chat, their discussions in the chat. So without any further ado, let me invite the tax director from Uganda, John Tusabe, to give a few opening remarks. John, the place is yours.
Thank you very much, James. I'm not sure whether, James, you introduced yourself. Let me take the pleasure of introducing you. James is an advocate of the High Court in Uganda, so you can call him Counsel James. Thank you very much for taking the lead on these discussions. One, I would like to thank everyone who is on the call on this very important subject, and most importantly, our bosses or the revenue authority representatives from the various countries. We really thank you for making time to share with us on this important topic. For the participants, the reason why we thought it would be good to hear from the revenue authorities on transfer pricing audits is that across the world, transfer pricing is increasingly becoming a major issue for revenue collection. And as East Africa, you might know that we are struggling with meeting our recurrent and capital expenditure as a region. And most of the countries in East Africa are battling a huge debt repayments. And those debt repayments have to be financed using taxation revenue collections. And where do the revenue collections come from? Some of the revenue collections come through audits. And one of the audits that is critical is transfer pricing. Sometimes when we're engaging with clients, they ask us a number of questions. How do I ensure that I'm compliant and such that by the time KRA or URA or RRA or any other revenue authority comes on board to check whether I'm compliant, I'm doing what is expected from their perspective. And sometimes it's really difficult to know what is actually expected by the revenue authority. Yes, there are laws, yes, there are regulations, but even those regulations, there are some aspects which are not clear cut. And so we thought it would be very helpful to hear from the revenue authorities in terms of what do they expect of the taxpayer? What are their focus areas? What should a taxpayer do to ensure that they are compliant? Because at the end of the day, when it comes to the risks of transfer pricing, the adjustments, the penalties, they sit on the taxpayer. So it is important that as a taxpayer, you get to know what the revenue authorities are thinking or expecting of you, such that you work with your tax advisors or consultants to ensure that you comply. At the end of the day, you're trying not only to manage tax risks, but at the same time, you know, revenue collection or contribution by organizations is also a sustainability issue for businesses, because as a business, you're expected to contribute to the society in which you operate, and taxation is one of them. So, but given the gray areas that exist in the various aspects of tax and transfer pricing, hearing from the revenue authorities would be very helpful. And I want to encourage the participants. This is an opportunity for you to ask questions, and the team from the revenue authorities would be very happy to answer you and guide you, such that going forward, you're good friends with the revenue authority. When you get an email from or a correspondence from the revenue authority, you don't panic, because you know that you've been doing the right thing. So on that note, I want to thank you and welcome you to this webinar, and I hope that it is interactive as much as possible. Thank you. Back to you, James.
Yes, thank you so much, John, and thank you for introducing me. My apologies there. Yes, once again, I confirm, John. My name is James Mwagawa. I'm a senior associate with BDO here in Uganda. As he said, I'm an advocate of the High Court and currently pursuing the Chartered Financial Analyst Charter at level 2. Yes, so back to the program, we are going to go to our presentations from the various revenue authorities. Our first presenter shall be, our first presenter shall be from the Uganda Revenue Authority, and then he will be followed by the presenter from the Kenya Revenue Authority, who shall also be followed by the presenter from the Tanzania Revenue Authority, and who will be also followed by the presenter from the Rwanda Revenue Authority, and lastly, from Ethiopia. So from the Uganda Revenue Authority, we have Robert Luvuma. Robert Luvuma is a Chartered Financial Analyst. He's also a member of the Association of Chartered Certified Accountants. He holds training in international tax and has over 20 years of tax administration. Robert will be presenting on behalf of the Uganda Revenue Authority. So, Robert, the day is yours.
Yeah, thanks very much, James. I think you'll assist me. My camera will be off to project my presentation, but I'm glad on behalf of Uganda Revenue Authority, I'm glad to be here to present on international tax. You have already met one of my key results area. I'm supposed to do tax education with my clients, so this seminar comes in handy. It is something I'm going to report as what I've done. This Luvuma Robert, I'm the manager international tax in Uganda Revenue Authority. We are a small team, but we are learning, and I'm here to share with you what is our experience and so far what areas are we targeting. Next slide. Let us move to the next slide. Okay, this is going to be my presentation. This is about something which is very important always. For you to be able to do transfer pricing audits, you need a very robust legislative framework. If you have challenges within your law, however experienced you are, you may not be able to get the tax. The second area is transparency and access to information. And here, Uganda Revenue Authority is signed to the mark mutual administrator assistance in tax matters. I'll explain to you how it has helped us access information from foreign sources, much as sometimes the information is slow, but when it comes in handy. The third area is you must have the technical capabilities to tackle aggressive tax planning and other transfer pricing risks. So URA, through the support from our development partners, we have been working around improving all the three areas such that we are able to raise government revenue. Next slide. Let's move to the next slide. So these are our area, what we look at. We have our international taxation. We look at cross-border, we look at cross-border payments. Then we have our transfer pricing legislation. They are based on the arm's length principle. Then we have the transfer pricing regulations, but very important, our law, the way we designed it, we imported the OECD guidelines into our law such that whenever the OECD guidelines are amended, our transfer pricing regulation is automatically amended. We have a practice note on documentation requirements. We have also something on penalties. We are struggling before when we asked for information, the information was not forthcoming. We wanted a higher penalty, but incidentally, finance was saying that since we are starting, let us not impose very high penalties. So our penalty is about 30 million, not a lot of money for failure to provide information. Next slide. Next slide. I said we are struggling getting information because taxpayers sometimes information may not be accessible. So this is the network of what I was talking about, the mutual administrative assistance in tax matters. We can access information from many jurisdictions for transfer pricing and information for not transfer pricing. I'll just give you an example. There is a case where we wanted information and actually information was not coming. But when we wrote to that country, the countries which are deemed to be tax havens, their legislation is very robust. What they did, they went to their Supreme Court, got a court order, gave it to the taxpayer the other side to provide the information, and actually got that information very fast. So for us, the issue of access to information and signing into the mutual agreement process system tax matters has helped us a lot. Next slide. So the other areas we rely on decided cases. I know Kenya has decided cases. We have seen also some decided cases in India. We have had some decided cases in Zambia. The challenge sometimes we get is that sometimes these decided cases, when taxpayers are responding, they are quoted out of context. So whenever we come up with something and the taxpayer responds through a decided case, we read the whole case from start. Sometimes they quote what was decided in the lower court and leave what was decided in the upper court. So we read the whole case from the lower court if it reaches the Supreme Court up to that point. But our experience is that people cherry pick cases when they are responding to our issues sometimes. Next slide. These are the areas we do. Enhance international tax compliance for multinationals. We advise government on tax policy. We support other divisions in URA. We handle cross-border mergers and acquisition, and here we are getting a lot of money. Capital gains tax. We have our section 79 GA, which mandates if your ownership changes by more than 51%, then there is capital gains tax which is paid. And that capital gains tax is not paid by the seller, it's paid by the company whose underlying ownership has changed. It has helped us a lot to raise some good money. Then we enhance multinationals, we enhance tax compliance of multinationals for transfer pricing. That's where we have a very big job to do. Next slide. Next slide, if I'm too fast to tell me. Next slide. Didn't you go behind? DTA countries, we need to move ahead. So we are quite a small team. I report to the Assistant Commissioner at Taxpayers Office managers. I have 3 supervisors and the 4 officers, but we are adding another supervisor very soon. We did a mass recruitment and I thought we'll get about 9 people, but incidentally we got only 6. So we are still a small team, but we expand in phase-wise. Okay, let's continue. It's very important for a team in transfer pricing to be multi-skilled. So when we are recruiting, we look for people who have accounting, audit, but especially also we look for people who understand strategic management principles. Remember, the transfer pricing guidelines have borrowed a lot of concepts from strategic management, things like the value chain. So we believe that having some people with strategic management principle helps us. Then also it's very important for communication and negotiation skills and dispute resolution. We have been very lucky that most of our cases have been resolved through the alternative dispute resolution. We have not gone to court. Then we also have economists who do the industry analysis and the benchmarking of intangible. It comes in handy. Then knowledge of international tax principles. Here we have also lawyers. We made sure that each team has at least 1 lawyer, an accountant, and an economist or a generalist. That one helps us to review our work properly. Next slide. So when I look at the way we do our audits, we start from what we call related party disclosure forms. We send them to the taxpayer. They are not yet automated, but we hope to automate them. As we are reviewing the related party disclosure forms, we look for withholding tax if it has not been paid, VAT on imported services, but also we are trying to identify transfer pricing risks. So after reviewing the related party disclosure, and we think the case may be a candidate for transfer pricing, we carry out an in-depth transfer pricing risk assessment document. We request for document to do that preliminary understanding. After that, a decision is either made to drop the case or to go and do a transfer pricing review. That's where we do our function analysis, and that's where we go in to do the actual transfer pricing, and we spend a lot of time in doing functional interviews. As I've said, our cases have been handled a lot through dispute resolution, and our current CG encourages a lot of dispute resolution. It doesn't believe in going to court and spend there 3 years when you are doing one case. So that's how we go through our process. Next stage, next page, next slide. Okay. And for me, this slide is very, very important on the way we do our work. The first part is what is the fact finding, and we do a lot of fact affiliates and what they do and what drives value. Here we get a lot of information. We go to that part of the group which is called investor relations. We go to the investors relation and we try to get information which the taxpayer is trying to tell the investors, the general public. That information has been extremely useful in understanding what takes place in the group. And what we find sometimes, we find that some groups are so diverse that what is in the group may be just like 10% of what is done in Uganda. Even groups which are doing manufacturing in Uganda, they may be manufacturing only 2 items, but at the group they may be manufacturing. They may be in manufacturing, in consultants, in transportation, all that. So it helps us to know what is taking place at the group and what is the group telling investors. The second bit, which for me I think is the most important thing which came out of the new transfer pricing guideline, is what we call delineation of the actual transaction. That concept is very, very important. It's to describe the transaction. And for me, the simplest way of saying it, if you can't describe it, how do you price it? And this thing is not about using labels or being generic. As we are interviewing, our interviews, I didn't say they range between 2 hours and 3 hours. They are so detailed because we want to understand what is the transactions. We are doing one of the cases, and this guy said we are getting know-how. So the question, we told them, what is this know-how? Explain what is the know-how. We discovered that most of the know-how is there, but there are things to do with providing IT systems. So the second question becomes, is this something which saves you revenue? Is it something which contributes to revenue directly, or is it something which is a cost saving? So if we delineate and discover that this is an IT software, very expensive, it's about cost saving, then we say, is this unique? Then we go searching around. Are there other people using the same system? Are there people providing a similar system? Sometimes you'll find that actually what they are calling know-how or to be so confidential, you'll find that this know-how sometimes is readily available on the market. There are third parties who are providing it. So for us, the issue of describing the transaction is very important. And as you are trying to describe the transaction, I've seen people using labels. We go behind the labels to know what is it. One of the cases we are handling, somebody say we get a lot of support from the group about best practices. So the question becomes, you get best practices. How did those practices become best if they are unique? They were telling us, oh, our best practices are very unique. The question is, if they are best practices, how come you are telling us they are unique? My understanding, if they are best practices, it means most of the people in the industry will be using them. Then there is that other important thing which came in on risk allocation. We also spend a lot of time on interview. So we're saying, how do we conduct the functional interviews? They not from COVID-19 is before we used to carry out our interviews, go to the taxpayers' premises, do the interviews, come back. But what we do because of online Zoom, we allow even group people to be involved. So all our interviews are done online using the virtual environment. What it helps us is that we record, we tell our taxpayer that we are going to record, but also if there are any integrity challenges, sometimes people make allegation. We have a recording of what we discuss. Sometimes even people allege not integrity, they say we are rude. There is a record of what has been recorded. But here, as we interview, this biggest challenge we get is that sometimes the tax people want to answer operational questions. We usually advise that let the tax people, they can slightly clarify, but they cannot answer a question which is being asked by an operational person. So here, and that one for us, we are very, we insist so much that the questions must be answered by the people. And as we are asking questions, we don't go directly to TP. We start from somebody's job description, which tells us what the person does. So as we are interviewing, you tell the person, you ask the person what they do, they are able to tell you what they do. Then the issues of transfer pricing comes in. I'll just give you an example. There's a case we are doing, and actually, as we are interviewing the salesperson, the person was telling us that actually, what everything is doing is being done by the group. So my question, we asked him that actually this person had worked as a salesperson with most of the multinationals in Uganda. So we asked him, how have you used your experience in the other multinationals to help this company? And the guy told us that actually, before coming to this company had a different sales model from the group. But he discovered that that sales model was not working in the Ugandan market. So he explained how he introduced the sales model which was being implemented in another multinational, this company. He was able to explain how the sales growth, how the sales grew by implementing that model. So sometimes it may not be necessarily true that all the support which adds value comes to the head office. Most of the time it does, but sometimes it is the people here. Then we do a lot of research about people's LinkedIn to see what people do. LinkedIn profiles for us, they are very important for us. we do organizational chart, what we call organogram. That one's very important for me because I'm able to identify the key people I need to interview. I ask that document at the start. If I don't get it, I'll not be able to start. We struggle to get third-party contracts, but we have been successful to get them where we have tax treaties. Usually people say they are confidential. So I say, if you think they are confidential, let me ask through the exchange of information. And usually that information comes. Next slide. Next slide. Okay. This is on about documentation, slightly document requests. This is okay, master file and all that, but we get a lot of information from using the exchange of information. Cooperation with you are a team. We expect people to cooperate to minimize disputes. I've discovered also sometimes we come up with wrong tax because we have not understood the taxpayer. For us, we spend a lot of time understanding the taxpayers. When I'm going to audit a manufacturing company, I go to YouTube and see and first understand how is that product manufactured. I ask people internally, we get experts who take us through the manufacturing process. By the time we come to your company audit, we know exactly the process flow. We are able to know whether your process is unique or is the generic process. We expect timely submission of information and request here. If we have requested for information and it's not available, we allow extensions, but the extension should not be forever. We are a bit flexible, but we advise if we ask, instead of waiting to compile and send information at once, you can send whatever you have got such that we progress. Continue. So these are the sectors we are doing. We are doing manufacturing. We are doing financial services, especially bank. Commodities, these are very important for us. We started with coffee. We discovered that actually in the aquaculture, IMF did a report and we are not getting any revenue from the aquaculture sector. So we started with, we said what sector is more organized. We discovered coffee. We said, let us start with the coffee sector. And so far we are moving on very well. We had a lot of challenge accessing information. Actually, we use the tax treaty network and also the mark to get information. We were not successful in getting 100%, but we get about 50 to 75% of the information. We are also handling the telecom sector. If you look at these sectors, these are the sectors which are contributing a lot in terms of what to GDP. We have not included the construction sector. We are not yet there. Next slide. So if you have clients who are in this sector and they have transfer pricing issues, and this one for us has been very important, strategic partners. We are supported by the Tax Inspectors Without Borders. We are supported by the African Tax Forum. Then also we are supported by USAID. But as I said before, the way we are doing our work, we are the consultants from these teams were not heavily involved, but because of the online nature of the work now, they are involved in the case from start to end. And for us, it has helped us acquire knowledge, especially interviewing skills, being able to ask follow-up questions. Sometimes we find that the person we are going to interview has been coached to answer in a certain way, but because we are working with experts, they are able to ask relevant questions and the person is able to respond, and this has been excellent for us. But also next year, we are moving to the next level. We are going to attach our people to Her Majesty's Revenue Services. We requested we shall be attaching 2 people every 6 months, such that we try to learn from the best. You continue. Next slide. Oh, I'm done. That is what we have in Uganda Revenue Authority. As I said, we are a smaller team, but we have learned a lot, and I believe we are doing a good job in the cases we are doing. I'll stay behind for any question or comment on our work. Thanks very much, BDO team. Thanks very much, participants. Please be free to ask any question. As I say, for us, in URA, this is one of my jobs I'm supposed to carry out. We are with partnerships with our clients, and it's hard for international tax to organize a conference where you get the people you want, but usually we prefer the consultant firms to organize and we come in. That's when you get the actual people who understand our work. Thanks very much. I'll stay behind for any questions. That's all what I have for URA. Thanks very much again.
Thank you so much, Robert, for that wonderful presentation. What I've picked from you is the issue of particularization, or being detailed in as far as your analysis is concerned. And for the participants, I think what to pick is that if URA is going to be that detailed as far as going to your LinkedIn profiles and trying to delineate the transaction, visiting YouTube to understand your business, then it's equally important for you as a taxpayer to ensure that you also go into as much detail as possible, not just to refer to the form. If the agreement says it's a lease, you need to look into the details in order to determine that it's an issue of substance over form. Yes, so for those who have questions for Robert, kindly put them in the Q&A. Robert is available. He'll be answering those questions through that Q&A section. I can see already some people asking questions. I think Robert will be addressing them. Someone was asking what triggers a notice to submit info on associated parties. That was Dina. Yes, so Robert will be answering those questions. As Robert is answering those questions, we shall go to the representative from the Kenya Revenue Authority, Anne Maina, to give her presentation. Anne, the days is yours.
All right. Good afternoon, everyone. Thank you very much, James, for this opportunity. So I hope I'm audible, and I'll also try to share my screen.
Yes, you are audible.
Uh, Hello, I've tried to refresh. Is it better now?
Yes, we can now see the presentation. And you are also audible,
Okay.
so you can commence.
All right, thank you very much. So my name is Anne Maina from Kenya. I work at the Kenya Revenue Authority at the International Tax Office, and I'm happy to share with you. So I will start with the outline of my presentation is follows, so I'll put on the full slides. So I'll just go through a quick introduction about transfer pricing, the legal framework in Kenya, and the transfer pricing audits in Kenya. So as we all know, we have many international entities or even businesses having transaction across borders, which has brought in the issue of transfer pricing. And it's estimated that about 30% of international transactions take place between related entities, and OECD estimates it's about the 60%. Hence, the concern for transfer pricing for both countries and also multinational entities. And this kind of transaction can take place between any different kinds of entities like a parent, subsidiaries, among others. So are we okay? I hope you can still hear me.
Yes, Anne, we can hear you.
We can hear you. We can also see your screen.
Okay, thank you. So with that, and also the increased globalization where countries are able to trade with one another, this has led to the increase in the number of transactions. And also there is now a close attention to these global businesses. And we've had cases in the media and even in the courts targeting these multinationals, not just the big ones, but even the smaller ones. So many countries have come up with laws mainly to protect their revenue base. And most of the laws follow the OECD transfer pricing guidelines. And like even in the case of Uganda, which follow the arm's length principle that applies across many countries, including Kenya. So these laws require that if an entity is dealing or trading with another related entity, they should price their transaction such that the transaction is arm's length or such that the transaction reflects the market conditions. And our law is mainly based on this to ensure any transactions between related entity is priced as it would have been if such transaction was taking place between independent entities. So our laws, we have the Income Tax Act.
Hi, Anne. Sorry for cutting you short. Your slides seem not to be moving.
Entities, if they... Oh, okay. I think I will reshare. Stop sharing. And share. Just a second. Sorry for the technical issues. But as
And perhaps I could assist you with sharing my screen so that I can share this, move the slides from this end. Anne, are you still there? And your microphone is on mute. Kindly unmute. Anne, are you still there? Anne, we still can't hear you. And if you're having some technical challenges, you can let me know so that we can have another presenter as you try to address them. Kindly let me know in the chat room. Okay, I think Anne is having some technical challenges. We can have the
She's joining in a second.
All right, sorry about that. I think Anne is still having some technical challenges from our end. But in the meantime, we can hear from Steve regarding transfer pricing issues in Kenya as Anne tries to address those issues. And if by then she hasn't addressed them, we shall continue to the presentation from Kenya. And hopefully after that, Anne will have completed addressing the technical issues. So Steve.
Okay, well, thanks a lot. So Kenya, transfer pricing in Kenya, particularly audits, are actually the most intense audits in our professional experience. KRA conduct different kinds of audits, customs post-clearance audits, which are intense, or normal in-depth audits, investigations of different nature, compliance checks, but transfer pricing so far is the most intense audits that many of our clients, many people in industry really experience. So it is a real area of concern for people who are managing companies, for CFOs, for CEOs, people in the accounting and finance functions. This is a critical area. If a company is having cross-border transactions with related entities, if a business has a wing of it or aspects of it which are operating in preferential tax regimes, for example, export processing zones, special economic zones, exempt entities, or entities that pay tax at a lower rate, for example, developers of affordable housing. If these entities are having transactions with related parties and the resident in Kenya, they are eligible for transfer pricing audits. And the intensity is always there. So of course, the first line of defense is to have a good, properly prepared transfer pricing policy document prepared by a serious, seasoned expert. That is the first line of defense, really. But of course, you also have to follow and adhere to the transfer pricing policy document. It is not uncommon for us to find that businesses have good documentation, but the implementation is not consistent. Sometimes it's adhered to, or it's adhered to in regard to some transactions, but not others. So this is a big area of concern for professionals, because then you have to resolve a more complex problem of non-compliance with the document which is on the table. So after, if a business has a good document and it has adhered to the documentation, in our experience, the transfer pricing concerns are actually, KRA normally drop, normally they drop this as an issue. You find that there is really no assessment coming out, or if an assessment comes out, it's on other taxes and not really related to TP. The audit will be rigorous. The inquiry around the document will be crisp, but there will be no assessment that will come out of it. KRA is quite professional in terms of the quality of the document that they present, either as a pre-assessment document or as an assessment letter. So that really works. A good document adhered to always works. Of course, we are also dealing with scenarios where either there is no document on the table which is good, or the document which is on the table is shambolic or completely inadequate. It has not been prepared in adherence to the rules, to the guidelines. It's just some document which is very thick or very big, but really it did not follow the requirements for documentation as outlined in Chapter 2 of the OECD guidelines, and it's completely departed from compliance requirements. If that is the case, then we go into a dispute situation. Now, this transfer pricing disputes then are actually quite interesting. For us professionally, it's big business. But of course, for the businesses that are affected by this, it's quite a lot of headache and big risk. So the name of the game is to ensure that once KRA knocks, the audit is handled very well. Or something as complex as transfer pricing, the audit needs to be handled professionally. You cannot just handle it. It's not wise to just handle it with your finance teams and to provide documentations and explanations, because that can escalate the level of risk. So it is best to handle it professionally. When handled professionally, the threshold of risk significantly drops. But not all the time it is handled professionally. and a dispute only comes for us to handle once an assessment or a pre-assessment letter has been issued. So
Hi, Steve.
this-
Sorry to interrupt. I just wanted to know if Anne is ready because I see she's back on the call.
Okay, Anne, are you ready?
Yes, I'm ready.
Okay, and then you can proceed.
Okay, thank you. All right, sorry, I dropped off. James, you can please project the slides. So we can, you can tell me once they're ready. I'm not able to see the slides.
It will appear. Moses, James has already shared it, so you can proceed.
Okay, all right. We had moved, I think we were on the slide on the legal framework. And I was mentioning the legal framework in Kenya. It's mainly governed by the Income Tax Act. We have a section 18.3 that guides or ensures that if there is any transaction between a non-resident person and a related entity, it should be, the circumstances should follow the arm's length principle. Then section 18.3 is supported by the rules, the transfer pricing rules of 2006. So the rules give the processes and procedures that companies that are covered under the by transfer pricing in Kenya that they should follow.
And your audio is not coming through properly.
Supports the arms and food. Okay, all right. I'll move closer to the mic. So we can move to the next slide on the transfer pricing rules. Yeah, the next one, yeah. So the transfer pricing rules provides the entities that are covered. So the entities that are covered by the rules it had been mentioned, it's where we have transaction between a non-resident person and a related entity that is resident in Kenya. Then, yeah, this is the scope. Then the transaction, permanent establishment may be an office, a brand, as defined by our income tax, its head office that is transaction should observe the arm's length principle. And any transaction, as has been mentioned, between a resident person in Kenya and a related entity in a preferential tax regime, such as an entity in an export processing zone, which enjoys tax holiday for the first 10 years, or another entity that may be in a special economic zone, which also enjoys lower tax rates of 10% for the first 10 years and then 15% after 10 years. So if there's an entity in these preferential tax regimes that trades with a related entity in the regular regime, those transactions will be governed by the transfer pricing laws in Kenya. Then the rules also provide for, we can move to the next slide. The rules also provide for, before I go to the requirement for documentation, This is just a highlight of some of the transactions that may be covered under that are covered by the rules. So any transaction that involves sale of goods or purchase of goods, or sale, purchase, or lease of tangible assets, a sale of use of intangible assets, or provision of services, lending of money between related entities, or any other form of transaction that may affect profitability of entities, should observe the transfer pricing rules. Next, please. So we also have, we are guided by the OECD guidelines, and we have a case law, the Unilever case law on transfer pricing, which supports that where the law is not adequate, we can refer to the international best practice, which is mainly the OECD transfer pricing guidelines, and also the UN manual. So these documents are available to access for both multinationals and also the tax administration when determining or when applying the arm's length principle on related party transactions. Next, please. So these are some of the documents that can be accessed online. Then there is something I needed to mention. The transfer pricing require multinationals to maintain documents. Transfer pricing, we commonly call it the transfer pricing documents, which details the process that has been followed to arrive at an arm's length transfer price. So these details should show how the functions that each entity in a controlled transaction or a related party transaction, the functions played by each entity involved, the assets held, including how the appropriate transfer method has been selected to determine an arm's length price, and any calculations made, and any other supporting information when determining a transfer pricing. A transfer price that is arm's length. So these documents should be maintained by any entity in Kenya that is affected by the transfer pricing rules. So the commissioner has the power to request this transfer pricing document from time to time and to review it when necessary. So it's important for entities, any entity that has any relations with a related entity that is either non-resident or in a preferential tax regime, it should maintain upon request. So rules or regulations which were introduced in the Income Tax Act, which are effective from January next year, it requires transfer pricing documentation reports to be filed for companies that have parent entities in Kenya that meet the threshold. The threshold that was provided for is 95 billion per year. So that will affect entities that are parent entities. But for any other entity, there is no requirement to file transfer pricing return, but they are supposed to maintain it and have it at all times, such that if the commissioner needs to see it, they can request and it's provided by that entity. Next, please. We can move to the next slide on transfer pricing audits. So, like we are all aware, transfer pricing audit is just like any other, and audits are very important, especially to have self-assessment system for tax. And Kenya and many other countries have that system. This is a system whereby individuals and entities file their own
on and off again.
Tax returns. They calculate their own taxes and file their own tax returns. So to ensure that, or to check on the accuracy or correctness of these audits are important in such a system. And that also justifies having a transfer pricing audit. So any audit is supposed to ensure there's compliance, to deter evasion, or even collect revenues. So with transfer pricing audits, some few things that it can generally take, and usually takes longer on both the multinational or the entity involved and also the tax administration. It requires us to collect a lot of facts, like it was already mentioned by Robert from Rwanda. It requires staff and also a lot of time to start with understanding the business, what it does, to do a proper functional analysis. So that requires a lot of time and also resources on both sides. Even the multinational, it requires resources even to prepare and maintain such, and even when complying when an audit arises. And another thing to note with TP, because most of the time it may involve huge multinationals, it may have huge revenue implications. And it can also be, and usually something to note, is complex, mainly because of the complexity of it and also some uncertainties that arise due to in some of the transfer pricing issues. It can take even more than a year to conclude. Next slide, please. So in Kenya, we have a centralized unit that deals with transfer pricing audits.
Your audio is
under the
on and off
domestic
again.
tax department.
Kindly look into
It's
it.
called International Tax Office. So I'm in the international office. So we do transfer region. So it's centralized. The organization and also. So most of our cases on where risk is at the highest, and this is the common practice, and it's also recommended by the UN manual, such that resources, since we are also, the unit is also not so big, we are about 30 number, the entire unit that deals with transfer pricing audits. And so that means also resources will focus on the most risky cases. So some of the things we look at are the transfer pricing indicators. And here, just an example of some of the things that may indicate there is a high risk. One of them is having large control transaction or large number of transactions with related entities. Another indicator is having persistent losses in the local jurisdiction, that would be in Kenya, having persistent losses in Kenya. And you find the entity with persistent losses is dealing with other related entities out there. So that there could be a risk indicator, and these are some of the things that might make the tax administration have a closer look on what might be happening. Another indicator is having the levels of income, the level of income or rates of return being significantly lower than the industry average. So you find some companies that have related party transactions, they are having like very low margins compared to the standard in those industries that they're operating. The other indicator is you find this entity has related party transaction, yet it doesn't have proper documentation of the transactions. And then you can have a transfer of intangibles or other high income producing assets, especially to other related entities in low tax jurisdiction. This is whereby you find an entity, say in Kenya, is transferring some trademarks or some brands or brand names. It transfers them to an entity that is in a low tax jurisdiction. That could be an indicator of transfer pricing risk, or having large payments being made to affiliates or related entities in low tax jurisdiction. Such payments may be in form of royalties. So you might find an entity is paying huge royalties to another entity in a low tax jurisdiction. Or you find they're paying rental payments, maybe they're leasing equipments, or paying large or huge management fees for receiving maybe some advisory services or paying interest payments or insurance payments to entities in low tax jurisdiction. So some of these are risk indicators, and once you see such kind of transaction, it may require to see what's happening. So these risk indicators does not necessarily mean that an entity is not compliant, because some of them, there are some that may indicate that there could be chances of underreporting of revenues. So then the other thing is that the audit will be conducted like any other. So it will be, we can either have a desk audit where all this information is gathered, because once we identify there's a risk, the next thing would to get in touch with the taxpayer and request for relevant information, including the transfer pricing policy and any other supporting documentation. So then we can do the audit, or we can analyze this information. It can be a desk audit where we don't have to visit the taxpayer, but in most of the cases, we'll need to go on the ground to see how the business is actually conducted and talk to the people to really learn how the business is done and how it operates. So then after that, if we are satisfied that the entity is compliant, the case ends. If we have some issues that we may not agree on, then the case may escalate so that we have a dispute. So if we have a dispute, the dispute will follow the normal court process, just like any other tax dispute. We normally have, under our Tax Procedures Act, it provides for objection. So if the business is not happy with the tax decision from an audit, they can object to that decision, which can be, see they're not happy with the response to the objection, they can go to the courts to appeal. Another avenue available for TP disputes, apart from the normal legal process, within the country, we have the mutual agreement procedures, and these will apply where we have tax treaty with the country that the non-resident is located. So the non-resident person can approach their tax authority, then the tax authority will approach the Kenyan tax authority, so that we can have a sitting and try to discuss or come up with, or to resolve the dispute through the mutual agreement procedure. So this has been used in a few cases. We've tried to test it, though we don't have a success example with the maps, but we've tried it in a few occasions. But it's available for entities to try and reach a solution through the tax authorities in their different jurisdictions. Then apart from maps, we have safe harbors and advanced price arrangements, which we have not yet implemented in Kenya. But these are some of the tools that advanced price agreements and safe harbors that we will be in the process of trying to legislate to reduce the number of disputes. So safe harbor is a tool that allows, it has been suggested by the OECD guidelines. It allows an entity, or to give some entities or a scope, a number of transactions, they are exempted from the regular transfer pricing regime. So they may given like a simpler process to follow to determine a transfer price. So this increases certainty and also reduces the complexity. While an advanced pricing arrangement allows the entity and the tax administration to sit and discuss and agree on an arm's length transfer price before the transactions happens. And once they sign or they agree on this price, it will be applied in future transactions. So this also increases certainty and reduces chances of disputes. But these two tools, we are yet to utilize them in Kenya. We have not put it in legislation yet. But in basically, that's the procedure for TP audits. Then to conclude, we've seen the TP regulations in Kenya. So entities operating in Kenya that have any transaction with related entities in preferential regimes or non-residents or that are non-resident, they are subject to the transfer pricing rules, which requires them to maintain documents. And the other obligation, apart from maintaining proper transfer pricing document, they should adhere, and most importantly, they should adhere to the arm's length principle. And of course, the commissioner has the right to request for this information. And also we encourage cooperation in case we have an audit, so that to reduce the chances of dispute and to ensure fair administration. So thank you very much. So that's my presentation. Thank you for listening. Thank you for your patience.
Thanks a lot, Anne.
Yes, thank you so much, Anne, for that wonderful presentation. You were challenged by the technicalities, but your points came out quite properly. Your emphasis was on the risk factors, but also on the available dispute resolutions. Just like Robert, I would kindly request you to stay around and answer some of the questions in the Q&A. I can see Dina again asking you some questions. So yes, while Anne is answering those questions, we shall proceed to the representative from the Tanzania Revenue Authority, Sweetbet Soka.
Hello, everyone.
Yes, Sweetbet Soka is a legal counsel in Tanzania. He specializes in transfer pricing and tax treaties, and is currently working with the International Taxation Unit at the Tanzania Revenue Authority. Soka, the day is yours.
Thank you, James. Hello, everyone. I hope I am audible. I don't know if I can get an opportunity to share my screen. I think it's easier that way. Can everybody see my screen? Hello?
Yes, we can see your screen. Kindly put it in the presentation mode, and maybe you could try shifting. Yes, yes.
That's better. All right. So like James said, I'm a senior legal counsel. I work with the Tanzania Revenue Authority within the International Taxation Unit. Today, I will make a short presentation on how TRA deals with the transfer pricing. Now, there was a major assumption that was made while we were preparing our presentation. We understand that this one is the second webinar, whereby the first webinar kind of like covered all the regulatory framework and insofar as transfer pricing is concerned. So our presentation will dive into what are the workings within the Revenue Authority whenever we want to deal with transfer pricing issues. So I also, you will forgive me, I will not have that like a recap of the rules that Tanzania we have. But if you're listening to what Anne was presenting, I think our rules are almost the same. And I think if you wanted some sort of a recap, you could get in terms of what rules do we apply. So my presentation will go straight to what Tanzania Revenue Authority do when it comes to handling transfer pricing issues. I think, like Steve said, it's one of the complex issues that most developing countries are grappling with. So in Tanzania, we have over 3,000 multinationals, and we understand that most of them have related party transactions. Now, within the International Taxation Unit, where most of the transfer pricing issues are being dealt with, we only have around 20 people, and dealing with over 3,000 M&E could be difficult. So the decision as to what cases are going to be handled at what time has to be very, very important. And so this presentation will try to walk you through or how TRA handles, decides what cases should be handled, and how then, once that decision is made, how then the whole transfer pricing audit is concluded. Now, we understand this is very important because of the issues in terms of the capacity, the resources, the number of taxpayers, and also the know-how among most of auditors. So the decision to select cases is rather important. Also, the whole auditing part is also technical, and we also needs technical know-how. So because of the number of people we have, so we have to be very careful in deciding what cases we handle. So perhaps we start with the how do we make an assessment? How do we review what cases we should handle at any particular time? So we are being guided by a number of questions, because we understand that we do not have enough resources to handle the cases at the same time. But we also understand that to decide, I mean, the whole transfer pricing audit is a serious commitment, and we wouldn't want to waste resources on a case that might not have that impact in terms of revenue collection. Like I think when James was talking about during his opening remark, we really need, as developing countries, we really need an impact in terms of revenue collection, and transfer pricing is one of the areas that most revenue authorities are looking as a way to collect revenue. So the decision to select cases in terms of the resources we have to balance that in order that we only allocate resources to those cases that will have an impact. Also, we also need to minimize unnecessary cases, or in cases of cross-border transactions where the treaties will apply, then we will also need to reduce the need to have a lot of mutual agreement procedures, because they will take a lot of resources. So we'll start with asking yourselves a number of questions. Whenever we want to make a decision on what, ask whether they are material control transaction. So that will help in us deciding whether a certain case is a case worth pursuing. We also have to ask ourselves, is there any indication that there are some transfer pricing risks, or where we've noted that there might be an erosion of a profit from Tanzania to other low tax jurisdictions? We also have to ask yourself, is it worth it to pursue a certain case? Sometimes you might find, because according to our regulation, transfer pricing regulation will also apply even to domestic or local related party transaction. Not necessarily they have to be cross-border, as in case of Kenya. So at times we really need to ask ourselves, is there a risk in terms, is it really worth pursuing a local transfer pricing issues? If the answer is yes, then we'll have to make a decision whether to include it in the plan or not. And then we'll have to ask ourselves, what is the specific issue that needs to be addressed during the audit? That will also help the auditors to have like a laser focus on what needs to be addressed. So in this table, it tends to summarize what are the things that we will look in terms of identifying the risks before we decide what cases we should take. And if you look at the very first column, you will see the potential risks that we need to address. So like if there are significant transactions with related parties in a low tax jurisdiction. Now, in most cases, if there are indication that a certain company has a really significant transaction with a low, with countries that we consider as low tax jurisdiction, then that will raise some flags, and then we will have to go and try to investigate further whether there might be some transfer pricing issues. Now, where do we look for that information? Normal circumstances, I think you'll find it on the return, on taxpayer's return, or in the case that a taxpayer has submitted the transfer pricing documentation, then we will find those information in the transfer documentation submitted. Also, another risky transaction is those transactions that involve intangible. So if I think this is also the same issue that Anne raised, in a situation where you have a related party transaction where valuable intangibles are being transferred from a local company to an associate that is not in Tanzania, then that will also raise some flags, and we'll have to look further to see whether the transaction raised some evaluation issues, whether the transaction was at arm's length, and then the whole processes, transfer pricing rules and regulation will have to chip in. In most cases, we'll find this information in the returns, also in the transfer pricing documentation, and also in the financial accounts. That because companies are obligated to also file their financial accounts. And also you can find it in the patent office. So whenever we get this information, it gives us an indication that perhaps it's something that we need to look further into. The other issue that might raise some risks could be business restructuring. Now, I understand that there might be, under normal circumstances, business restructuring will raise some transfer pricing issues. And under normal circumstances, we'll have to go to inquire further and to see whether this restructuring triggered some of the transfer pricing issues that we might need to look into. And we usually get this information from the file documentation, the transfer pricing or returns or the financial accounts. But in most cases, we find this information on the press reports or trade magazine or securities. So currently, our FCC has a tendency of requiring all companies that have undergone any or are intending to undergo any restructuring to notify the AFCC. And usually we now will get most of the information from the AFCC to TRI of the potential restructuring that certain companies might consider, or in the event that the entire restructuring process is completed, then we'll have to see it, and then it will come to the International Taxation Unit for some further evaluation. Also, some specific payments might raise some issues. I think also Anne alluded something about this one in terms of the interest, royalty payments, and so long as, and this is most important when we've noted that the quantum of these payments are significant, and in most cases they're going to low tax jurisdictions. Now that will also raise some flags, and we'll call upon our team to investigate further and see whether there was some transfer pricing issue. Again, most of this information, you'll find them in the documentation that a taxpayer is required to file. Also, for loss-making companies, perpetual loss-making, if we find that there's a company that constantly make losses, and we also note that there's no attempt or any significant attempt from the taxpayer to change the business operation or try to find some financing, then that will also raise some issues in terms of whether the transactions that that company conduct with the related party are actually in arm's length, or if they occur, then that will be decided after the audit. And usually we will get this information from the annual returns or transfer pricing documentation. For those companies that are registering poor results, I think also Anne said something about this one. If you find that there's a company that performs poorly compared to the peers within the same industry, then that also raises some flags as to why that is the case. And this is more important where that company transacts with a related party that might not be in Tanzania. And in this case, that will raise also some issues, and then we will have to investigate further. Also, at times, we will look at the effective tax rate, and this will, the time we compare the effective tax rate of the local company vis-a-vis the effective tax rate of that is reported at the group level. And if there's a significant variation between the effective tax rate that is being reported by local company vis-a-vis the group's effective tax rate, then that also will be one of the criteria for us to look a little bit further to see whether there are some transfer pricing issues that we need to consider. Again, same places you will find those answers. You will find them in the file TAPI documentation, or in the tax returns or consolidated financial accounts of the group. Give you some indication whether the risks do exist. Again, in the case there, we found that there's no or poor documentation that is being submitted with the TRI. That also will raise some flags. We've noted that at times you find that taxpayer will report in the financial statement or that there are some related transactions, but there's no filing. And that will also give us a red flag that we need to go further and investigate, see whether those transactions that were reported in the financial statement were actually conducted in the arm's length. And then we'll have to approach the taxpayer and see what is the reason of non-filing. At times, I think also Steve said, we find that taxpayers will just dump a lot of documentation, but they do not have any standards because the regulation provides the standards that the transfer pricing documentation should be. And in this case, if you find documentation that does not meet the standard, then it gives a rather huge indication that perhaps the testing whether the transaction at arm's length were not really sufficient, and then that will give us a reason to go further. With the excessive debts, I think this is rather obvious in terms of if you find that a local company have excessive debts, that under normal circumstances that local company will not get those loans from an independent party. Suppose that that local company decides to go to the bank, then that will also give an indication that maybe the transaction with the related party might not be in arm's length, and as such, it will trigger further investigation. Like I said, these are the main sources that we will find information that will help us in determining whether certain cases are worth pursuing and what cases just it's enough to just let them go or just give them time before you go and investigate them. So we look at the returns and audited financial statement that is mandatory. They must be submitted with the Revenue Authority. We look at the transfer pricing documentation. I understand that Yusuf was presenting during the first webinar our transfer pricing documentation requirement. We look at them and see whether they've actually addressed everything according to the law. Also, Google. We Google a lot to see whether you'll get some information in terms to some of these companies. Also, we also have we have subscription to some commercial database. You can get some information in terms of relationship, where there's any transaction or structuring, and also securities analyst reports. You can get it from local security market authority, or you can also get it from those other security reports. There also, at the same time, while we have high risk indicators, we also will have a low risk indicators. At times, and this is where we will know where we should put much of our emphasis. So if a company has a significant unrelated minority shareholders, then you know that at times the risk of related party transaction might also be minimal. Where transactions with jurisdiction with a higher marginal tax rate, then you know there isn't a really good incentive. Again, this is not a conclusive one, but it also gives an indication that there might not be an incentive for a company to shift profit from a low tax to a higher marginal tax rate. Also, in a similar transaction with unrelated parties are similar under similar conditions. So if we find that a taxpayer transact with both related and unrelated, and we don't see a lot of a difference in terms of the quantum and also the price at which they're charging, then that also shows that they might not be higher transfer pricing risks. In terms of where there are companies that their group policy is consistent, they are always compliant. We have those companies that every time you go, you find them, their things are in order, their policy, they are following their policy, their compliance level is high. Under normal circumstances, we just put them in a what do you call them, the green lane, in a sense that you just go after 2 or 3 years to see if they are still following. But those are not those companies that you have to lose a sleep over, because you know they are compliant. Where there's we don't have a lot of uncontrolled transaction, then we don't have to waste time. So you have to look at the quantum of the transaction. But also, if there's a high, in terms of the information, there's a strong compliance, there's a high level of transparency and open engagement with the taxpayer, then we might not really waste time for those companies. We just put them and make some sort of and we could also deal with this company through desk review. We don't really have to go and conduct an actual field audit. Now, how then do we take all this information, all these risk indicators? How then do we translate them to whether this company really needs to be audited, and whether you should conduct a field audit and like an exhaustive field audit, or do you just need to go and conduct a desk audit? Now, under normal circumstances, there are people, I cannot really say for them because I'm just a lawyer. They are really good people that that handles these parameters, and we usually have a tool that we can feed all this data, and then the tool will give you the results on whether the data that you've just fed gave you what results, what companies should be audited and what level and stuff like that. So there are a number of parameters that under normal circumstances, those guys actually will have to address. So you'll get the quantitative data from the returns, the contemporaneous documentation, but then again, there will be a high level identification of possible transfer pricing risks, like the one that we have identified. So if you see there's a transaction with a related party that is in the low tax jurisdiction, then you'll go to that box. And then there's going to be another level of quantitative to see the potential risk. So the quantum of the risk that under normal circumstances you might really find. And then you review that information. Then after you review that information, then you make a tentative decision whether you should proceed with those lists or you should drop them. And that will take you to an in-depth risk review. And, that will include analysis of the function and comparability, the description of within the documentation that was submitted. And that is not enough. Then the guys will also have to do another quantification of the potential risk. So it's not just enough to say that we have these companies that have conducted this type of transaction, but they have to go further and determine what is going to be the potential in terms, suppose we pursue those companies. Then they will present a draft report, and then the decision will have to be taken whether those companies will go for audit or will just be, I mean, and if they're going for audit, what type of audit? Then at the end of the day, a report will be taken. Now this report will make a decision what companies will be included in the financial, I mean, in the audit plan for the year. And usually this whole process is done the last 2 or 3 months before the beginning of a new audit year. And those companies that graduate, then those are the ones that will be audited. So now assuming that the whole process of identifying what companies that fits the criteria as risky company that needs to be audited. So now on a really, like Anne already said, this is just like a normal audit, following all the procedures of audit. There's nothing special to it. However, in part for TRA, we have 2 types of transfer pricing audits. So you have what we call them audit plan cases. Now these are the cases that originates from the risk assessment report. Now that the risk assessment report will tell us, okay, these are the companies that you really need to audit for this year. But also, we also have what we call them issue-oriented. Now, these are the cases that the normal audits, the ordinary audits might find out there are some cases that have transfer pricing issues, and the auditor might feel that he or she might not be in a very good position to handle those cases. So they will refer those cases to the International Taxation Unit for us to handle them. But again, once they get to an International Taxation Unit, the process of actually auditing is the same. The only difference is where they originated. So you might find some cases during the normal audit. I mean, during the risk assessment, we missed some cases, and during the normal audits, auditors will find those cases, and then they will have to alert us, and we will step in and try to troubleshoot the transfer pricing issues in those cases. So once we have a case, we'll start with our initial engagement, taxpayer engagement. We'll notify the taxpayer of the intention that we want to commence a comprehensive transfer pricing audit. And this letter will be followed by an entry meeting. And this entry meeting is usually done, say, a week or so before the commencement of the actual audit. And the intention of the meeting is to clarify the scope of the audit, and also will identify the information that we need, and so that we can give the taxpayer enough time to collect the information and send it to us before we actually go for field audit. And usually this is done at the taxpayer's premises. After the entry meeting, we usually will send a formal request of information. Now, usually this is the information that we established during the entry meeting, and we'll make a formal request because legally there's some whenever there is a dispute, we need to know, the information that was requested forms part of the evidence during the audit, during the dispute. So we'll make a formal request of information, and so that auditors can also review in case the transfer pricing documentation did not contain all the documentation. After we've received, usually we'll give a taxpayer, say, 7 to 14 days to submit those information. And if after we get the information, then we'll go for it. Now, depending on the nature and the gravity of the case, it could be a desk, or it could also actual physical visit at the taxpayer's premises. We prefer the field audit because it really works well whenever we want to create, we want to prepare function analysis, function assets and risk analysis, which is very crucial for transfer pricing. So when we go there and conduct interviews on the field and see how operations are done at the taxpayer, then it will give us an opportunity to be more fair to the taxpayer, because when you get the time to understand the operations of the taxpayer, then that will make us will put us in a better position to decide whether the transaction, as reported by the taxpayer, were actually at arm's length. And this is where we find out a lot of things that were written in the transfer pricing documentation do not really match the actual conduct of the taxpayer, but in some cases they do match. Then after that, after we conduct a transfer pricing audit, we will prepare a draft of and communicate the transfer pricing findings, audit findings, and also that findings will be communicated to the taxpayer, and the taxpayer will be given at least 28 days to submit a response. Now, after the taxpayer has responded, then a number of meetings will have to occur and correspondences. Again, this is where all the arguments and back and forth will be done, because we want to exhaust everything in terms of giving the taxpayer the chance to explain and state his case, and also the tax authority will also present their case. So it will be followed by like 1 or 2 or 3, sometimes even 4 meetings in between before we actually conclude. Then we will go for a close, what do you call them, an exit meeting. During the exit meeting, then we'll agree the areas that we actually agreed with the taxpayer and areas that we haven't really, we have agreed to disagree. And from there on, we'll go back and prepare the final audit. This will only be done after we've all exhausted all our arguments, and taxpayers has been given all the time, again, reasonable time, not because the experience is taxpayers will never want things to, will never want to see the assessment, just want to keep dragging these things. So after that, we will issue an assessment if there's a need to issue an assessment, but if at all our audit has concluded that, has confirmed that the transaction with its associate were at arm's length, then that is concluded there. So what is the lessons? I've tried to give you some sort of a summary of what goes through within the tax administration in deciding what cases we want to tax, and we've also gone through the actual audit process, and the decision is there. Now, I understand also Yusuf during the first webinar explain how hefty some of transfer pricing penalties in Tanzania are, and perhaps the best way to handle transfer pricing, in our opinion, as a tax authority, is to be compliant, because the cost of non-compliance and normal circumstances is very huge. Most of the disputes that we get is because the taxpayers do not want to pay the penalties. So before the change of 2021, the penalties for not really adhering to the arm's length principle was 100% of the adjustment. And that is a hefty penalty. So if I adjust a taxpayer, say 10 billion Tanzanian shillings, the penalty, I understand that the 10 billion Tanzanian shillings will result into like a tax of say 3 billion. But the penalty is 10 billion. And that is really, really steep. And usually that's one of the reasons most taxpayers will decide to object. But recently we have changed our law in the sense that now the penalty is only 100% of the tax not paid. It is still very significant. And also non-compliance of the documentation, on filing of the documentation or late filing could also trigger up to 52 million shillings penalty. So what I'm trying to put across here is that perhaps complying with the transfer pricing regulation might be a very good idea, and perhaps I'll urge, because I know I'm speaking to a lot of taxpayers on the other side, to actually take time and look at our rules and try to comply, because it's easier that way. That being said, I think I have completed my presentation. Thank you for listening.
Thank you so much, Soka, for that wonderful presentation. And the key highlight from that is actually in one word, compliance. Short of that, the punishment or the penalties are quite hefty in Tanzania. Soka also highlighted a number of procedural aspects from Tanzania in quite an elaborate way, and I hope all of you got them. Just like Anne and Robert, Soka kindly assist with addressing some of the questions. I saw Yusuf assisted in answering the other questions that had been raised. The participants, Soka is still around, kindly give him your questions in the Q&A session. We are going to proceed to the tax representative from the Rwanda Revenue Authority, Judy Mbugua. Judy is a lawyer. She has also studied economics and she's a certified public accountant. She has over 10 years experience in tax administration in Africa and has worked with the private sector as well. So Judy, the day is yours.
Thank you. Please confirm that you can see my screen and that you can hear me.
Yes, Judy, I can see your screen.
All right, thank you. So now we are going to go through the tax laws on transfer pricing for Rwanda, as well as a quick highlight on the transfer pricing guidelines in Rwanda. Thereafter, we are going to have a highlight of the bilateral and multilateral agreements of Rwanda, as well as and then thereafter we will go through the transfer pricing audits and what we expect of taxpayers. So now it is not a secret that multinationals have complex transactions, and generally they try to look for opportunities to maximize their tax function. And while they are doing so, transfer pricing issues arise. Even if they are not trying to maximize their tax function, transfer pricing issues arise because they will have to trade, or they will be required to trade with each other. So now tax compliance and transfer pricing compliance all over in the world is a very serious issue, and we have not overlooked it as Rwanda and as Rwanda Revenue Authority. And because of this, we have really been trying to make sure that our laws are in line with international best practice and in the best interest of Rwanda. In this regard, this is a highlight of the laws that we have had so far. The reason why I have highlighted past laws is because some taxpayers may find themselves being audited for periods that had these laws in place, and you see we cannot apply current law retrospectively. So we had law number 16 of 2005 and article 30 just obliged related parties to operate at arm's length. We have come from far, and between 2005 and 2007, we were looking for ways of having transfer pricing guidelines, and finally we had them in 2007. And then thereafter, in 2018, we had law number 16 of 2018, where we had article 33. I'm sorry, I have not highlighted it here. And article 33 obliged related parties to have controlled transactions documented. Then now, just last month, we revised law number 16 of 2018, and now we have article 32, which obliges related parties to have documents and to make sure that they apply the arm's length principle for all their control transactions. In December of 2020, we had published the ministerial order on transfer pricing. We call that the transfer pricing guidelines for taxpayer. It is meant to actually supplement the income tax law. And this also supplements, or rather is referred to under Article 32 of law number 27 of 2022 that was published last year. We also have many bilateral agreements and multilateral agreements, which we will go through shortly. We will start with the income tax law that was published last month. So now I'll just highlight the quick issues that are relevant for intra-group transactions. There's the definition of related person. It remains largely as it was under Article 33 of the previous law, just that we added a new addition to be considered as related parties, and this is the last bullet. A person who is under control or in direct control with another person. We had an interesting case last year, and that is what triggered this issue, where we had a big group. Of course, they were operating under a similar name, and they claimed that they were not related simply because they had indirect common control of a person. It did not mean that they were related. So it really raised a lot of issues and debate, but we cured that. We tried to cure that. Then we have the definition of PE, permanent establishment. The law has largely borrowed from Article 5 of the UN Model Tax Convention. There's not much difference. And of course, we have dependent agent PEs, where a person has authority to negotiate or conclude contracts on behalf of another person or in that other person's name, or where that person plays a principal role leading to the conclusion of such contracts. Such persons are considered as PE. Our Article 5 of the new law also lists exceptions where we have persons that are not considered to be PE, and that is strictly borrowed from the UN Model Tax Convention, Article 5. Then we have Article 32. I'm just highlighting the relevant provisions. I had mentioned Article 32 and the requirement for documentation. Additional issues in Article 32 is that the authority, the tax administration, RRA, has power to adjust prices or profits, basically to make a transfer pricing adjustment. Further, Article 32 gives taxpayers the right to request for an APA, advance pricing agreement, from the tax administration. So we would be more than happy to negotiate with the taxpayers before they undertake certain transactions. And as long as they do full disclosure, transparency is key. Article 68 introduced anti-abuse rules on avoidance arrangements. And we take this very seriously. That's why we had to have the GAR provisions. And I will just highlight them and go through them very quickly. And it consists an arrangement where the purpose is only to obtain a tax benefit. For example, where you can have a person doing treaty shopping, it is simply for tax benefit, and where it is of course clear for us, or where we have an arrangement that lacks commercial substance. Also, where we have an arrangement that creates obligations or rights that would not normally exist between independent parties, or where an arrangement may result to the abuse of the laws in Rwanda. So if a taxpayer is found to be abusing the rules, the tax administration can treat that arrangement as if it never happened, or it can recharacterize that arrangement or any payment into any other thing as it may deem fit. The tax administration can also disallow or reallocate income or loss, or even deem persons to be the same person, related persons to be one and the same person. So then let me do a quick highlight on the transfer pricing guidelines. So the transfer pricing guidelines apply to persons, to transactions between residents and non-resident persons, including resident-related persons. Sometimes you may find two entities are in Rwanda, they are both resident and they are both related. The transfer pricing guidelines apply to them as well. They also apply to non-related persons where the transaction relates to a PE, or where persons are transacting with a person in a beneficial tax regime. I'll show you, I will give you a listing of what is considered to be a beneficial tax regime. So any trade with a person in a beneficial tax regime is considered to be under, to be under the scope of the transfer pricing guidelines, or where persons, okay, largely I have gone through it. These are the characteristics of a transfer price of a beneficial tax regime. A regime that taxes income at 0 or taxes income at 20% or below, or a regime that grants tax breaks or tax holidays to non-resident individuals or persons, or one that does not require a taxpayer to carry out substantial economic activities, or one that does not tax foreign income or taxes it at 20% or below, or a jurisdiction that does not allow access of information about corporate structures of legal entities. So these are the transactions that are subject to adjustment of prices. They are the same as the ones Anne had very ably listed. I don't think I need to go through them. You can get them in Article 5 of the transfer pricing guidelines. The transfer pricing guidelines also gives a list of methods that are considered or are considerable for compliance with the law. And they are the traditional and the transactional methods. Then we have an alternative method as long as it satisfies the conditions under Article 14 of the guidelines. So about documentation, taxpayers are required to have a transfer pricing document, and they are also expected to have all intercompany agreements, as well as a country-by-country report where the ultimate parent is in a jurisdiction or is in Rwanda, in a jurisdiction where it is required to have such a report. Then we have a TP annex, transfer pricing annex. It is supposed to be filed with the tax administration when filing the annual tax returns. So the annual tax returns in Rwanda are filed on 31st of March or on or before 31st of March of the next year. So we expect taxpayers to file their annual tax returns together with the transfer pricing annex. Taxpayers are also expected to have the global organizational structure, the group structure, or any other documentation they may consider necessary to show that they are complying with the arm's length principle. This includes benchmarking studies. there are certain taxpayers that are discharged from this obligation of documentation, and we can find this under Article 20. I don't want to take too much time with that. The documentation should be in place before filing or before undertaking these transactions. Taxpayers are not expected to submit like every year, but they are expected to give the tax administration, when requested, such documentation within 7 days. And then now, but the annex, as I mentioned earlier, is filed together with the annual income tax declaration. So I'll go through the international agreements that Rwanda has, just highlights. So this is the network of DTAs Rwanda has. There are about 14 of them. And of these countries, Rwanda does exchange information with them, because you realize that for transfer pricing audits, as Yusuf mentioned, it is data intensive, evidence intensive. So when there is need, we exchange information with these countries. In August 2021, Rwanda signed the MAC, and just as Uganda mentioned, we are it will be effective from 2024, and we expect to have automatic exchange of information with all the other signatories. And we are taking this very seriously, so that we are able to get information from the other signatories and do successful transfer pricing audits. So what happens with the audits in Rwanda? The first thing is risk profiling. That is what happens. And there's a risk department, a risk division, risk profiling division at RRA, and it conducts the risk profiling of taxpayers on an annual basis. And then thereafter, it allocates these taxpayers to different units in RRA. So in RRA, there is the International Tax Unit, which largely undertakes transfer pricing audits. But also, we have other divisions which do other audits, general audits. But these other divisions, or auditors from these other divisions, may come across transfer pricing issues. Unlike Tanzania, where they are referred to the International Tax Office or the Transfer Pricing Unit, here in Rwanda, our auditors undertake all audits, including transfer pricing issues, with the support of the International Tax Unit. And this is in our effort to create capacity across board, so that all auditors in RRA are able to do transfer pricing audits. Just as a highlight, I don't want to really repeat what Mr. Soka and Ann Maina said about the common transfer pricing risk indicators. Maybe just to highlight those that were not mentioned by them. And they include where taxpayers have complex group structures, and really together with frequent business restructuring, we wonder why they do this. And we always believe it is to align themselves with the tax maximization business or profile, so that they make sure that their taxes are minimized. That is always a risk. Sometimes when taxpayers do this, they forget the issues relating to substance. The other issue is shared costs with unjustifiable allocation keys or basis, and as well as procurement services from related parties. These services usually are embedded in the cost of sales. This is a very serious risk indicator that we have come across. So now, in relation to the general audit process that we follow, I don't want to repeat what my colleagues have said, because I realized there's not much difference. But once a case has been issued, for example, to an auditor, then the years to be audited are cleared, or it is very clear for that to be mentioned to everyone. And then there is a broad analysis of the taxpayers' circumstances, so that we check whether it is maybe the taxpayer was having a business penetration strategy, and therefore it is not very wise to consider some of the transactions, such kind of issues. Then we try to understand the control transactions. We do the same things as Yusuf said. We go to LinkedIn, we go to YouTube to understand the business. We also look at other databases, including Companies House in the UK, and yes, generally that. Then we also review whether we can have any existing internal comparables. And if not, then we look for external comparables. We have subscribed to many commercial databases for this. Then we look for the most appropriate transfer pricing methods, and then we make adjustments where necessary. We then share this with the taxpayer. After we share this with the taxpayer and we have discussed with the taxpayer, the taxpayer has an opportunity to appeal, which they do, or to come to us for an ADR process. And this is done through the senior management team or with the senior management team. So then what is required of taxpayers, given all this that I have mentioned? We expect taxpayers to prepare and submit audited financial statements. You realize that most countries in the region have 30th June as the deadline, and for Rwanda it is 31st March. So there's a shorter time within which all this should be done, and we urge taxpayers to do this in time, together with the preparation and submission of the TP Annex. So the deadline, as I mentioned, is 31st March. We also expect taxpayers to keep the transfer pricing documents together with the benchmarking studies in their premises, and not to start preparing them when requested to provide them by the auditors. We also expect them to make sure that all transactions that are with related parties or all control transactions are at arm's length, and we expect our taxpayers to comply with the transfer pricing guidelines. We also welcome taxpayers, those that are interested in an advanced pricing arrangement, to come forward and get in touch with us. That is the end. Thank you very much.
Thank you so much, Judy, for that wonderful presentation. I think Judy joins the other presenters. Of course, Rwanda has a number of unique aspects, like the beneficial tax regime, but I think she joins other presenters, that is Anne, Robert, and Soka, in underlining the various transfer pricing risks that the revenue authorities consider. And the takeaway for most of us is that there's a kind of directed approach to audits in East Africa here, where we are looking at various risks. So it's important for taxpayers to ensure that such risks are kind of addressed in whatever they are doing in their businesses. So I hope this is something that you're picking up. There are questions in the Q&A. So Judy, you could also check in there and see if there's something to answer. Some of your colleagues are already addressing them. Otherwise, we are going to proceed to the presentation from the representative from Ethiopia. My understanding that it's Samrawit going to present. It's not the Revenue Authority. The Revenue Authority sent in their apologies as the presenter got an emergency. So Samrawit, the place is yours. Samrawit, are you with us? Your microphone is mute.
Hello? Hello?
Yes, we can hear you.
بالظبط. Hello, can you hear me?
Yes, we can hear you.
Hello? Hello?
Yes,
Yes,
we can hear you.
Samarwit, we can hear you. And it looks like you're sharing the whole screen.
So,
Probably you could only
as-
share the presentation.
As Julian has said, the tax representative could not make it because of illness. So they have apologized for not attending the transfer pricing webinar. The detailed presentation about the TP guidelines, it has been already provided on webinar 1 by some of our colleagues. So I would not give a detailed review or outline about the TP guidelines. So I will only focus on the practice in Ethiopia. So just to highlight on the TP applies on the transactions, including international and domestic related persons with annual turnover of 500,000
Sorry, Samarwit, sorry for interrupting.
So
could you
when
kindly,
we look at the TP audit,
we cannot see the slide properly. Could you put it in a slideshow format?
So when we look at the TP audit and review in Ethiopia, as most of the presenters has presented here, the transfer pricing audit is at its infant stage in Ethiopia. So the department is led by, currently the department is led by 2 teams only, and they are on the process of developing the department, increasing the number of tax personnel on the department, and also they are on the process of creating awareness by taking airtime on radio and TV programs and other promotional activities. So the other one is most of the companies, especially international companies, and also some domestic companies are engaged, who are engaged in relating party activities, have no know-how about the TP audits and review. So basically, these benchmark studies and filing of documents and also submission to the tax office is usually done by different consulting service like BDO and other consulting services that are found in Ethiopia. So usually companies are not aware about the forms and agreements to be shared to the transfer pricing department, as it is not known by the clients or customers, unlike other East African countries that has been presented here. So the TP department, that is the tax office transfer pricing department, has signed an agreement with UK for practical knowledge transfer to make the department active, as it has been inactive for more than, also the transfer pricing department has been established like in 2008. It has not been active yes, so they are trying to make the department active, and they has signed an agreement. And additionally, the audit is usually not backed by comparatives. So I have heard from other East African countries, they use benchmarks and comparatives, and have also software and also engaged with different countries or companies. But here in Ethiopia, the tax audit is still not active, and they usually use similar methods like the one that is used for normal tax audits, that means non-TP tax audits. And they don't have software to compare with, so they are in the process of purchasing softwares and for comparative and using the benchmarks. So still this is the process that is done by the TP department of the tax office. So practically clients for TP audit and review are identified when the clients are called for tax audit by chance. Usually before 5 years, like on the third or second years of the company's business, after commencing the business license, tax audit are to be done like second or third year. So usually when the clients are identified that they are engaged in related party activities, then they will be transferred to the TP department. So that is when it is identified that the client is engaged in the transfer pricing or in related party transaction. So this is practically what it is, what it has been done in Ethiopia. So just to highlight generally, as you have mentioned in other East Africans, I think for the Ethiopian transfer pricing department or the tax office transfer pricing department is still at its initial or infant stage, and I think a lot of things has to be done in future. So this is just to highlight the practical transfer pricing in Ethiopia. Thank you very much.
Yes, thank you so much, Samarwit, for that brief discussion on transfer pricing in Ethiopia. It looks like the Ethiopian Revenue Authority is still taking some steps to arrive at certain levels of compliance audits and reviews. But nonetheless, they have taken some steps which still call for taxpayers there to ensure that they comply with the regulations in Ethiopia. So we are going to go to our next item on the agenda, and that is to have a few comments from a senior manager from Uganda relating to the transfer pricing regime in South Sudan. Juma, you're welcome.
Apologies, Juma. You seem to still be muted.
Oh, sorry. I hope you can hear me now.
Yes, we can. Yes.
So there's a question which came in the chat regarding transfer pricing in South Sudan, and they were asking why we don't have a representative from the National Revenue Authority. That is the Revenue Authority in South Sudan. So in the previous webinar we talked about transfer pricing guidelines across the region. That is East Africa, and we also talked about South Sudan. So this one we're talking about TP reviews and audits, and not having South Sudan represented was deliberate because as we mentioned in the last webinar, we said yes, South Sudan has transfer pricing rules. We talked about the scope. They only concentrate on cross-border transactions, unlike Uganda and Tanzania, which also talk about local transactions. also talked about related party issues. We talked about the arm's length, talked about the transfer pricing methods, which are really not very different, and the documentation requirements. Now, the issue with South Sudan, they don't have detailed TP guidelines, like in the case of the other countries in the region. But they have TP rules, which are mentioned in Section 81 of what they call the Taxation Act of 2009. So it is just a brief there, but when you look at it in terms of documentation requirements, it's really not very different from the other requirements for the countries in the region. Now, regarding the TP reviews and audits, we had a chat with the National Revenue Authority there, and we're trying to find out how they're going about this, how rigorous these are. And the information we got is that really, as you know, South Sudan is still really an infant, still in its infancy. When you look at the Revenue Authority, it's also very, it's not really advanced. So the feedback we got is that there are really not a lot of rigorous TP reviews being conducted by the Revenue Authority. And that is why we didn't get representatives from the National Revenue Authority to talk about TP reviews in South Sudan. I thought I should mention that for purposes of clarity, since this is since South Sudan is in the East African region, and we are talking about TP reviews. So that's all I can say. Thank you, and back to the NC. James, thank you.
Thank you so much, Juma. Yes, thank you so much, Juma, for your discussion on South Sudan. The floor is open to the Q&A session. There are some unanswered questions in the Q&A, particularly in relation to Uganda. Perhaps the team from Uganda can assist in answering them. Then as the team is also answering those, if there are any other issues that the respective experts or panelists would like to emphasize, this would also be the time to do so. I'll start with the team from Kenya. That is Steve and Anne, to see if they have anything to add or to emphasize in respect to the questions that were raised in the Q&A, and some of the questions they were answering. So Steve?
Oh, okay. Well, thanks a lot. Some of the questions that were raised was in regard to someone mentioned about tax efficiency schemes and why Revenue Authority does not clamp down on this. What I would like to say is that, for the example of Kenya Revenue Authority is basically just a tax administration authority. They have to follow the law as it is. There's nothing particularly wrong with a multinational entity designing their tax affairs or any other affairs of theirs to be more tax efficient. This is not particularly forbidden in law. However, there are very clear guidelines. For example, it has been mentioned by Judy that tax efficiency schemes that are only designed to secure tax advantage may be disregarded. So those are the only circumstances under which a scheme may be thrown out if it has no substance, it's not compliant with the law, or it is basically an artificial structuring or transaction aimed at defeating the tax objective. I think that that should be a sufficient response to that. The issues that were raised in regard to selection of persons to be subjected to transfer pricing audits. I think many of the representatives from the revenue authorities have been consistent about the risk profiling and the selection, but they may add, Anne may add on to this as to what really KRA goes through in terms of selection of people to be subjected to transfer pricing audits.
All right, thank you, Steve. So what I can say is our audit cases, they will come from within the department. We'll have them forwarded from other departments if they have international issues or tax pricing issues. Transfer pricing issues, they'll be forwarded to us. And we have majority of the cases, we are the unit that does the risk profiling. So here we do not have a separate unit doing risk profiling mainly, but we'll also get reference from other departments of the cases. So how we end up with the cases, we do risk profiling. We can get information from the tax returns or from public available information. And then if we look at the risk factors and we find that there's a high tax risk, then we can write to the taxpayer to provide more information so that we are able to review their operations to see if they are compliant with the transfer pricing regulations. So yes, so in short, our cases will mainly come from either within our departments or from our own risk profiling within the International Tax Office. Thank you.
Yes, thank you so much, Steve and Anne, for emphasizing your points in those on some of those questions. We shall take it to the team in Uganda to address some of the issues that were raised and some of the outstanding questions in the Q&A section. But before we do that, the participants are encouraged to keep raising more questions in the Q&A so that they can be addressed by the team. Yes, so in Uganda, we have Juma and John. There's an issue that was raised by Jimmy. I had asked Robert, but I think Robert had left. He was asking, would you briefly highlight the common cases your office in Uganda deals with, given that transfer pricing agenda is like a new kid on the block in African setup? And we're also grateful for OECD guidelines and the support from offices like yours to educate and popularize such topic. So I think he's looking for the common cases URA deals with, given that transfer pricing is new in Uganda. So over to you, John and Juma.
Thank you, James. Jimmy, you're right that transfer pricing is quite a new subject in Uganda, whereas the regulations were introduced in 2011 and they became effective operationally in 2012. Over the years, effort has been put on building capacity. When you look at, say, where Ethiopia is now, that's where Uganda was. And over time, Robert and team have built a team to assess these kinds of transfer pricing application. Now, from our experience, what we have seen in the transfer pricing audits, the focus in terms of the transactions that have been audited, things like management fees charged by related party entities, that have been one of the major areas of focus. There have been a review of interest on loans, whether the interest charges at arm's length. There's also been a focus on when I mentioned management fees, the URA found that entities that charge management fees based on percentage of revenue, that was a key risk area. And there are some businesses that were doing that. Many of those businesses were audited. Or when it comes to purchase or sale of products, it's mainly purchase of products from non-resident related parties, whereby you sell your goods to a Ugandan entity or distributor who you charge at a higher price so that you lessen the taxable profits in Uganda, and then you sell the products from a country that has a lower tax rate. So meaning that URA has been checking whether the products, when you send them to a related party in Uganda, are you charging a price that is at arm's length? And are you applying the appropriate transfer pricing method, like the ones that Judy mentioned? So I can say that those are the main cases that we have seen URA handle from a transfer pricing perspective. The area which is still a challenge at the moment is when it comes to the pricing of intangibles. That is one of the areas that is still a headache, which is not only for Uganda, but many other tax authorities. They struggle auditing intangibles, but it's an area of risk that has been identified. Thank you, James.
Thank you, John. I don't know if there are any other issues that need clarification from the questions that had been asked earlier from the team in Uganda. Okay, so I think the team in Uganda has addressed every question. In the chat, there was only one item that had been addressed to Robert. Maybe consider hiring some experts from here in Kenya. That was from RISPA. I'm sure Robert saw that. He will probably be considering doing so. Let's get the team from Ethiopia, Samrawit, to address some of the issues. There are some questions that were sent. I see some questions being sent through the chat. Members kindly send the questions not through the chat, but the Q&A item, because that's when they can be viewed properly. But I see some questions in the chat for the Ethiopian team. A question from Eba. The question is, the directive governing transfer pricing provides for advanced pricing agreements under Article 12. What is the practice of accepting advanced pricing agreements? Is there any advanced pricing agreement accepted? Which form of price? And the second question is, which form of pricing method is mostly favored by Ethiopian Tax Authority? EBA also says that there's a move to amend the TP directive. What is the status of the amendment? Samrawit, over to you. Samrawit, are you with us? I can't seem to hear you. Samrawit, are you with us? Okay. Hello, can you hear me now? Yes, so there's a question from Samson Deritu from Tanzania, asking the team in Tanzania, what does shareholder activities mean in transfer pricing regulations in 2014, 2018, and 2020? The term is not defined under the tax laws, but the term is usually common in disallowing intercompany in Tanzania. So over to you, Sweetbet and Yusuf, to address this question.
Sweetbet is not here, but I can actually, if Samson could give me his email, I can answer him in detail. But can you hear me?
Yes, we can hear you, Yusuf.
Yes, I can answer him in detail, but normally shareholders' activities relates to activities of the shareholder who is part of the multinationals. But I can answer him in detail if he can share his email.
Okay, thank you so much, Yusuf. Samson, you can get in touch with Yusuf for further guidance on that issue. Okay, we can now hear from the team in Rwanda in regard to addressing any issue that may have been raised and is still needs emphasis. So over to you, Judy.
Thank you. Thank you, James. There was an interesting question from Rubina Dina. I think she's from Mauritius. She asked about whether there's a list of beneficial tax regime. We do not have one in Rwanda, but we have given a list of characteristics of beneficial tax regime in countries. There was another question on principal purpose in anti-avoidance rule, and she asked whether how we interpret it or how we define it. And ideally, this is where we look at the sole goal of a transaction or an arrangement, where we see that a taxpayer has made an arrangement, and we can see that the sole purpose of this arrangement is not substance. There's no substance attached to it, but you can see the sole purpose of such an arrangement is to minimize taxes. Then it becomes an issue, and it lays squarely under Article 68 on anti-avoidance rules, and we can do the actions that are listed in Article 68 to address that, which we mentioned. They include disregarding a transaction or even recharacterizing it. I think those were the questions for Rwanda. We will be happy to answer any other question that may arise.
Thank you so much, Judy. We also have a representative from Rwanda, Fidel. He works with video. I don't know, Fidel, could you be having any additional comments to make?
Thank you very much, and I really appreciate the contribution from Judy, and Judy is from RRB, and she has given everything we needed to hear from Rwanda Revenue Authority. So thank you very much. Nothing to add.
Right, thank you, Fidel. So we still have some outstanding questions for Ethiopia. I don't know if
Hello,
Samrawit
James.
has addressed her audio issue.
Hello,
So
James.
Samrawit,
Can
there
you
are
hear
two
me now?
questions. They are in the Q&A session from Eba.
Can you hear me now, James? Hello.
Over to you.
Hello, James. Can you hear me now? Hello. Hello.
We can hear you.
Yes, we
Okay.
can hear
Okay.
you.
Thank you. Okay. Thank you.
Samrawit, we can hear you.
Okay, thank you. So the first question was related with advanced pricing agreements. So usually, as the teams are few, like I've told you, there are only two teams in the transfer pricing department. So for now, what is being done is that consulting service like video and others are assisting different international and domestic companies who are engaged in relating party transaction to file a form and also to have a price agreement, an advanced pricing agreement, plus the filing form and other related documents and submitting to the tax authorities. So it's just a submission. They don't usually review it, but they will keep it as a file under the client's tax filing. So that's basically what is being done in Ethiopia. And as to which pricing method is favored by the tax audit, like I said, so mostly what is being done is that even most clients doesn't know which transfer pricing method to use. They just usually use their own methods. And once the tax authority identifies that this is a related party transaction, then it will be transferred to the transfer pricing department for auditing purpose. So they usually audit and they also use estimation during the tax audit. So they don't have specific favorable method, but usually most companies, when they identify, they usually use the cost plus pricing method for their transaction. And most of them are usually involved on service providing that we have also encountered so far. So the cost pricing method is usually used, but that doesn't mean it is favored by the tax authorities. So I hope I have answered your question.
Thank you so much, Samrawit, for addressing those questions. Eba has an additional comment in the Q&A chat. You could probably answer it through that chat. The directive provides for 5 pricing methods. Okay, so we have come to the close of our Q&A session. I shall now take the opportunity to welcome Steve to give his closing remarks, and then we shall close our the session today. So Steve, over to you.
Thanks a lot very much. I take this opportunity to thank everyone who has participated in this webinar. Many of our clients across the region have joined us today on this issue of transfer pricing audits. I thank them very much for taking the time. I also like to thank the presenters, beginning with Anne, who is both a transfer pricing auditor and also a trainer at Kenya, at KESRA on international tax and transfer pricing, for joining us in this. And also Judith from Rwanda. Her presentation was quite illuminating in terms of the protocols that Rwanda follows in terms of the legislative framework. Rwanda is really the new kid in the block in terms of international tax and transfer pricing. She was really able to bring out the unique provisions in their law, and as well as outlining the process of selecting organizations for audits and how it is conducted. That was quite illuminating for most of the people who attended. The Ugandan presentation was quite comprehensive in terms of the process of audits, process of transfer pricing audits, and I greatly thank the team. as well as Tanzania and our colleagues who have joined us today. Now, this is going to be a series of TP or TP webinars that we are going to be conducting. We'll provide a link of this webinar to everyone so that they can watch it. It will be edited and then posted on YouTube for everyone. We'll share copies of the presentations with everyone who has attended, as well as also issuing certificates for everyone so that those who wish to claim professional points can do so. So I thank everyone, especially those who are actually not present in this. This webinar was organized together with the revenue authorities. There are senior members of those organizations who participated in reviewing the presentations, in approving our partnerships. They may not have been present here, but we also thank them as well for their support in terms of the insight and their contribution in organizing this. Otherwise, thank you very much, and we can now close the webinar.
Okay, thank you so much, Steve, for those wonderful closing remarks. Thank you much. Thank you so much.